Welcome to the Master Your Millions podcast, the show all about your financial potential and leaving a legacy for future generations. Here are your hosts, Jason and Scott Henderson.
Welcome back, everyone. I am your host, Scott Henderson, and my co-host is Dr. J. We are experienced investors with a huge advantage as we have been able to learn from our family that has well over 100 years of experience in real estate and other alternative investments. Here on Master Your Millions, we seek to share that experience we've learned and expand our knowledge as we talk to the top leaders in alternative areas of investing. We're super excited for our guest today. Jason, who do we have coming on?
Well, Scott, I am excited to have Kelly Korshak with us. He's the Chief Technology Officer with iFlip. Our astute listeners will remember that we spoke with the CEO of iFlip a few weeks ago. Just to give you a little bit of background, Kelly attended Stanford University. Actually, he started there when he was 16, and then he later went on to the University of Chicago and has a graduate degree then in mathematics. I think the undergrad was in physics. He has spent 30 plus years on Wall Street, investing over 4 billion assets for institutional banks and funds, including Deutsche Bank, Morgan Stanley, Diamondback Capital, Brevin Howard, and the Tudor Group. His strategy to investing is built around the approach that mathematical algorithms produce superior risk reward ratios in the stock market. This algorithmic intelligence approach led him to retire from Wall Street with his family in Arizona to start his own company, Flip Investor, or iFlip. His dream is to empower all individuals to grow their wealth through AI investment technology. So welcome, Kelly. We're so happy and thankful that you'd be on our podcast.
You're welcome, and thank you very much for having me.
So tell us, where are you originally from?
Born and raised in Chicago.
In Chicago. So heart of America, regular kind of guy growing up. When did it become apparent that you were super brilliant?
I always get taken aback when someone gives me an accolade. I never really felt I was brilliant in any way. However, if I have to recollect back, there was a few things that kind of gave me an indication that I didn't know at the time that it was an indication. But as I reflect now that I'm older back, I see that it was. One was I did skip the third grade. So at that time, kids that would move up a grade, I went in. It was pretty much a choice of the teachers. I was in a public school program in Chicago. I was very proficient at reading and in the third grade. So I spent a week in the third grade and got advanced into the fourth grade. And I can't remember the year, but I think it was around 1970 or 71, I think. I can't remember. And that's when that was an indication. Another indication was because I was born in Chicago and lived in Hyde Park, which is where the University of Chicago was. It was a time in history when things were kind of changing socially, especially in Chicago. If you remember the 1968 convention in Chicago, Mayor Daley's famous, shoot to kill order, anybody disrupting the Democratic convention at that time. Those were the backdrop of, me going to school as a very young kid. But I remember my first year, what was going to be high school, was in the University of Chicago's lab school, which is a school for precocious children, kids that, definitely were of a higher skill set. Generally, there were the professors' children that would go to that high school. At the time, I just thought it was normal. Looking back, I realized, okay, I skipped a grade and went to a special high school, for kids that were, I guess, smarter.
So what, then you went to Stanford and you were in physics. Why physics? Simply for that's fun, that was interesting.
Science.
You love science.
It's just science.
That's why I like you so much.
Science is the application of mathematics. It's about measurement. It's about understanding phenomena and being able to attribute the things and ideas and concepts towards the phenomena you observe. So generally, you've probably heard you observe, you theorize, and then you demonstrate. And that was always something I liked even when I was in grade school. And if you have a proficiency in math, you have the ability to make an observation, maybe nothing as profound as the apple falling on Isaac Newton's head. And you would say, oh, I see, here's the observation. The apple falls from the tree and it falls at a certain rate. It takes so much time to hit the ground. How can I demonstrate something that would explain that? And those kind of things, and by the way, that metaphor is something that I really took to as a young kid. And, physics is the perfect application of that. For example, as opposed to chemistry, where in many ways it's similar, but it wasn't my nature to, mix an acid with an alkali with an acid and say, oh, these things behave in this way. That wasn't something that was interesting to me. The occurrence of natural phenomena and the ability to measure it and then maybe demonstrate in some way, an explanation for it, I thought was just fascinating. So physics.
Cool, love it. So my degrees are in chemistry, and there's particularly my graduate work, I worked on something to where there was a lot of physical chemistry. So it was on the boundary between chemistry and physics. I don't know whether you remember the famous picture where they moved these particles on a surface and wrote out Intel on the surface. That was the physics professor that I was collaborating with, actually did that. It was in his lab. Anyway, so you went on to University of Chicago and in mathematics, and then we get into finance. How is it that you get into money management from being in hard science? I mean,
that's actually a more interesting story. I was at the University of Chicago. I had a lot of friends in the business school there. And, at that time, I think it was the Pritzker School. Was it the Pritzker School of Business? I think it is. Or was it the Sloan? It was Sloan or Pritzker at that time. I think it's Sloan now. And they, I was firmly behind, the mathematics at that time. I was studying something called in-dimensional algebra, which was a fascination for me. It was just imagine a lot of long linear equations. But recruiters came from Wall Street during the part of the year. It was generally around April and May, and everybody was invited, especially any people that had a scientific background or a math background, or especially the business school. And so some of my friends at the business school, said, come along for it. And they gave a presentation, many different companies, Goldman Sachs, Salomon Brothers, Citibank, and many others. You would go to them and they were offering the benefits is if, here's what you could do if you work for us. They would introduce us to mergers and acquisition, investment banking, AKA, trading the markets, global macro markets, and various other kinds of forms of finance offered by these investment banking companies. And obviously for the business school students, it was very, clear this is the direction they wanted to go to, whether it was marketing or finance. And for me, finance is just a simpler application of mathematics. And this is the early 80s, remember. And the thing that was kind of important at that time was coding. And because coding had just kind of evolved at that point. into the first object-oriented languages, and they were called like Pascal. And they were these versions that were above things that were offered like COBOL, which is a pure business language, or RPG, very similar, or BASIC. And, if you're in the physics program and or math programs, you're obviously on a computer, you know how to use them. And the recruiters were emphasizing the use of technology, which of course is nothing at that time to what it is today. And to me, it was three things caught me, which were, hey, good company was one. It's, hey, going to New York was another. The rate of pay was a very high paying job at that time. And you had the ability to double your pay with a bonus at that time. And finally, being able to do something in an area I never expected to have that I never had any other thoughts on, but fit with where my mind wanted to go, which was at that time, coding was a brand new thing. And the one thing the markets have was data. And it wasn't completely collected and organized as it is today, but it did appeal to me. And so it was definitely a choice that I'd never expected to have. And a bunch of my friends, they went, and I decided to tag along. I went to Salomon Brothers. Another buddy of mine also went to Salomon Brothers. Another one went to Goldman. Another, went to the West Coast, worked for Wells Fargo. So we all had a chance to, hey, we're graduating, and, what are we going to do? How are we going to make money? And I just took it because I had no other offers at that time. It was it would have been a seamless thing maybe to go over to Batavia and work in as a research agent at the accelerator there, which is just outside of Chicago. But it was, the idea to go to New York. I went to undergraduate on the West Coast, and going to my first job in New York, it seemed exciting. So I got the bug.
So
I love it.
What was the process? We started at the beginning of this show. We were talking about you working with Paul. So what was the process from going from Salomon over to working with Paul?
Yeah, there was many iterations between that. When you're at Salomon, I was there for about, 6 years. And I was there for 6 years. But when you're in New York at that time, you were always being recruited by other firms to go work for them. A lot of people don't realize there's no loyalty, especially at that time on Wall Street. If you could find a job for another firm, whether it was bigger or smaller, but that job would offer you a great deal more money, most people would jump ship. So there was no sense of loyalty in working with one bank or another. To us, they all look kind of the same. There wasn't, like today, the understanding that Goldman, of course, is considered the by far and above the best banking and investment banking company and bank in the country. They hire the best and the smartest. They always do well in tough times and bad. They're the best at hedging. They do hire the smartest people. It's just as simple as that. The lure, so you're constantly getting pulled in different directions to work for different firms. Paul was a special case. Paul was a trader. I mean, a classic, one of those guys that just knew how to trade and make money. There was other people in this time that were very similar, but they just didn't have the name Paul did. First of all, he's a good man. He's a UVA guy. He grew up in Louisiana. He's very humble. He's extremely honest. He's probably the finest man on Wall Street. He's deeply behind charity events that he started way back then, even called Robin Hood. No affiliation with the company Robin Hood. But he was just a person that a lot of people wanted to work for. And he was just his own shop. And it was a small shop, maybe $400 million of assets. Now, back in those days, today, $400 million isn't a lot of money. Even though it sounds like a lot, it doesn't appeal to people anymore as if that's a great deal of money. But back then, it was. His customers were all institutional, and he was a person that was completely laissez-faire. And he wanted to open up a agency of his business that took half of his assets and invested mathematically. And so he was looking for people, not like himself, which were seat of the pants, intuitive traders that knew risk and reward very well. He wanted to put half of his money to work in areas that involved mathematics. And of course, that was a natural to me. And I met him through some friends, and it was a small shop. It was 30 Broadway at that time. And it was literally maybe 4 blocks away from One New York Plaza. I was living at Battery Park at the time, so it was maybe a little closer walk to work, and it was fascinating. Also, the other reason for it was it was at that same period of time, some things were happening at Salomon Brothers that kind of were disillusioning. And so it just, I think at the end of the day, the seas came apart, and it made it very clear to give that one a shot.
So we were talking a little bit before we started recording that alluded to the road less traveled, right? You come to a fork in the path, and one was well worn, one's less. And you thought that maybe, tell us a little bit about that, because you almost alluded to also that maybe kind of I don't know if you'd call it a failure, but it may be looking back.
Opportunity cost.
An opportunity cost. Yeah, good.
Perfect word for it. It was an opportunity cost. First of all, I think everybody would probably agree that in life, choices are really things that involve some opportunity cost. If I do one thing, I can't do another, and so I lose an opportunity somewhere else, hopefully in exchange for getting a better opportunity, to where you're, feel is a more valuable one or a more fruitful one. When I was at Paul, I was doing things that I wanted, but not too long later.
Hey, Kelly, real quick, what was Paul's last name?
Jones, Paul Tudor Jones.
Okay, go ahead. We just need to specify, because people, Paul's a common name.
No, you're right. People that have worked with him or before, that's what they just call him, Paul. He's an icon. He was dating Madonna at the time. Just to give you an idea of the time, this is 86, 87. After the 87 crash, Paul Jones made a tremendous amount of money. We were there at the time when he did it. He was
on Black Monday. Is that what you're referring to?
Black Monday.
He was positioned in a way that he could make a bunch of money.
October 19th, right? October 19th was Black Monday, and he, for a year before that, was looking for it. There was people that would come in that were very famous at the time. People that were like Elders Futures or Tom DeMark or the Elliott Wave guy. I can't remember. I'll think of his name. Prisker. I forget his name. I got 40 years. Yeah, Richard. Yeah, and he was looking for it, and we were all there at the shop, and he caught it. He was the one that, literally more than tripled his assets on that one day. He went from a $400 million shop to a $1.2 billion shop in 3 days. He caught the move perfectly. No one else had the courage to do what he did. No mathematical formula could do what he did. And boom, he was literally on the map. The news was in constantly over the last, for that period of time and weeks to follow. And so he really came to light at that time because he was talking about it. He's low key. Most hedge fund managers are low key. You don't know who they are. They're not advertising. There was no websites, but everybody on Wall Street knew he made the money. But to answer your question, when you see something like that, and you see a man, go from 400 million of wealth to 1.2 billion, he personally, made about 400 million himself during that time. And so you realize, oh my gosh, you become instant, this kind of super wealth over a very short period of time. When you're a smart guy, like, I think everybody that worked for him was, you kind of feel you can do that too. And so not too long after that, myself and another person also at the same, at Tudor, we branched out and we opened up our own firm. We left on very good terms. And that thing did not work out. After just 3 years, that just did not work out. We just couldn't raise enough money. The markets had changed from 1988 to 1991, and it just wasn't conducive to either raising assets or managing the performance enough to be able to attract investors. We were a mathematical approach. It's steady, it works. However, it's not spectacular. It just works. It especially works for a longer term investor that wants to manage his risk, or even a shorter term investor to manage his risk. But the people that invest in hedge funds, they want these things, but they also want the name. They want the guy that has done it before. So you're battling against a track record of known value. And you need to be sponsored by people like that. You can't just move out on your own. So the regret I have was that, the guy, we should have stayed with it, because obviously the shop should have grown, and it did. And, you're one of a very small group of people where you're very likely to become part of future management. And you're very likely to be able to participate in a company's growth, not just one individual's growth. So in hindsight, I recognize you have to look at the boss, but the boss is just a figurehead of something that is even bigger and has more value than just the boss. And that was the mistake I made. The mistake that I could actually achieve the same things that I had witnessed at a very young age. Remember, at that time, I'm 28 years old, not even, I was 28. It's like you think you can do it yourself. And no, you don't realize you're around someone extremely special. And you just didn't recognize it. You drink beer with the guy, you don't necessarily realize that, hey, wait a minute, this is the kind of man that could become a billionaire or a president or something even bigger. So
on your
not taking.
So when you did split off and start that company, was that the foundation to iFlip now, or was the similar concepts used? Or
At the time, yeah, that's a real good question, actually, Scott. It was, in a way. At that time, algorithmic trading was really starting to catch on, and there was many new variants of it. There was, right after the 80s, some, computers were speeding up. For example, neural networks were starting to become popular. Data was more prevalent because the infrastructure for gathering data of all types, both fundamental and price, was becoming widestream. Anybody could get it. And yes, when I branched out, it's because, hey, I knew the services that were available, and I knew how to code. I knew, of course, what an algorithm was, very simple. But there was so much more you could build upon that that absolutely, you're 100% correct. That was essentially the same concepts that we use at Flip today, were things that were in some primordial form back in the very late 80s, early 90s. Obviously, we've evolved a lot since then, but yes, that was kind of the beginning of it in some ways, where it was part of my own business to try to use these kind of technology to manage the markets.
So you're a big guy about risk, all about mitigating risk and managing risk. And that's come from this mathematical background. Is my understanding that right?
100%. Look, it really comes to something simple. On Wall Street, everybody has a good idea. There's a lot of people I feel that are a lot like me, and I think much smarter in many ways. Not all of them are, but I think there's quite a bit of people out there. They all have, unique and novel ideas, and that could be applied to what their thinking is to make money inside the markets. But you have to understand the other side of it is, who's going to give you the money? Well, whether you're at a bank or a fund manager like a Paul Jones, or a bank which might be owned by a Bill Ackerman or a Sandy Lyle or those kind of people, they're going to say, okay, here, what is your idea? What's my risk? What's my risk to give you money? If you don't have a very good understanding of how to convey what their risk is, no matter how good your idea is, you will be dismissed. And the reason is because even if your idea is good, if you don't understand how to work within the rules of risk, then they don't know how to allocate to you. They don't know how to give you money. They don't just give you play money like $1 million and say, go play with it. If they lose it, it doesn't cost them anything. They want to see you have a plan that manages risk, a defined way of managing that risk, by the way, and know that you have the capacity to trade and maneuver a lot of money. So the mistakes always come from twofold. One, you have a good idea, but it's not scalable. In other words, it can only maybe work on a very small amount of capital. What's a small amount of capital? $100 million is a small amount of capital. Believe it or not, that's a small amount. They want to know that you can manage 400, 500 million and maybe more. That's number one. Scalability. They call it capacity. The other one is they want to know, how are you planning to risk money at different levels? And at the time, and it continues today, there is a very specific way of defining it. And you must know the language of it. And that is the job of the risk manager, who ends up generally hiring the people that are the traders or the people, the portfolio managers that sit inside of these firms. So understanding risk is fundamental to working on Wall Street. No money is given to a portfolio manager unless the risk is clearly defined. And obviously, to sum it up, if they can't define the risk, then how do they know if you're performing or not?
So it sounds like to me then, when you were at Deutsche Bank, that you had managers that would sort of rely on you to help them understand the risk and how to mitigate it and navigate through the markets. Is that correct? Am I saying that, or
not quite? No, the managers or portfolio manager that would come to a Deutsche Bank when I was risk management there would be a person that has an idea. It's been vetted by maybe other portfolio managers at the desk or other people that are in different firms. And they say, hey, this guy's got a really great idea. Could you take a look at it? Well, if you're in the business of trying to manage money, you're always looking at people with ideas. And it was the job of the risk manager, or my job, was to understand, okay, how do they manage their risk? How could they tell me that they knew how to manage risk? And generally, the answer is always, it's going to be a function of probability and risk. So essentially, what I needed to hear was that they knew within a certain probability that they would have no drawdown in any single day that might be less than 3%, more than 3%. If a person could convince me or any risk manager that they understood the risks, both systemic and market-wise, of their process, they could probably be hired. And then it was the job of the risk manager to just make sure that they're following their own rules. That their portfolios behave the way they were described to the risk manager when they were being interviewed. So it's not really my job to help them, but it would be my job to discipline them if, for example, we felt that risk was inordinate or profits were subpar. For example, there was many times when people would not make enough money because they were too afraid and were not willing to risk enough. And honestly, that causes termination every bit as much as a person that is always looking for something bigger, but he's taking too much risk, in his job to find it. So at the end of the day, it was more to contain the portfolio managers to manage risk the way they described it to me or any risk manager. We're all going to operate about the same.
Love it.
So question for you.
Go ahead, Scott.
So going off of the topic of risk, like you're an expert in this subject, how do you know when you aren't taking enough risk at a very important time or vice versa? Do you have some basic rules that you can just kind of go, oh yeah, like, can you share some of those with us?
Well, yeah, think of it this way. It's very obvious depending on the market you're trading. So everybody has a specific market that they like to trade or they feel comfortable in. Some of them are the bond markets. They are very interested in just trading debt. Others are the stock market. They're very interested in trading equities. Now, in the stock market, obviously, there's all kinds of area equities. There's insurance companies, there's oil and energy companies, there's banking companies, there's pharmaceutical companies. There's different sectors of companies that they all have different aspects, and the portfolio manager feels comfortable inside those areas. So, for example, ex-pharmaceutical company people generally wanted to trade the pharmaceuticals because they had some inside knowledge about how pharmaceutical companies worked, and they could help find out maybe where their earnings could be, and they knew how to measure that. So they felt that they could go to a trading desk and do well trading the things that they're very comfortable with. And that's similar to anyone else. But here's the real key to it. At the end of the day, the stock market generally has a volatility, if you just look at it on a day-to-day basis, that it moves up or down about 40 basis points every day. So basically 0.4% a day is a typical movement for the stock market. But if you're a trader, if I see that the stock market is trading 0.4% risk every day on an average day, of course it could trade 1%. Yesterday it was down 1.5%. If you see a trader that is trying to only behave within the normal constraints of the market, 0.4%, he's probably not going to make money. In other words, he's not risking enough. You must basically set your design up so that your portfolio moves in some multiple of an average day's movement. Now, we can define that mathematically in terms of probability if we want, but just in the very basic thing, what I would look for is to say, look, if I know a market moves, for example, 1% a day, I want a guy out there that's going to say, look, I think my portfolio will move around 1.5% a day. But by the way, it'll only do that less than 5% of the time. But he has it geared so that it is capable of trading, say, a multiple of, say, 2 or 3 beyond the normal volatility of the markets. I just want that person, that portfolio manager, to think this way when he is putting together his system, so he knows that he should risk something. We're expecting him to risk, but we need him to know that he's risking within a set of parameters where he knows that the probability of something really bad happening is still very low. That way we have time to correct it. So there is a rule of it. It's, you know, a lot of times we would say it's a 95 and 2. Basically, 95% chance that the market, that your portfolio will move less than 2% a day. 95% chance, kind of, you guys both probably remember from statistics, is basically 2 standard deviations above or below a normal distribution. And so those are the end points, which means that we're getting technical here. It just means that we know the high probability is that the market will not move more than 2% in the portfolio, you know, more than, say, than 95% of the time that the market will move less than 2%. And what that does is it gives the firm the ability to pull the brakes out if they see something aberrant. In other words, hey, the guy lost 5% in a day. That's way beyond his risk parameters. You can cut him back and it doesn't hurt the firm. You can put him in the penalty box. So we need to know that and establish that. So we know to say, hey, this guy has to be pulled back. We deallocate to him. Or, matter of fact, hey, we don't see that for a long time. You allocate more to it. So that is really the thing. We need to hear that language from people. And by the way, everything at Flip is designed exactly the same way. These are old concepts, but they still remain true. They're statistically based, and, you know, frankly, if you can find a better way, I'm listening to it.
So tell us a little bit about how iFlip came about. I mean, where did the idea? What was the genesis of the idea? Was you and Randy, you know, sitting around a table having a beer or something and say, hey, we got to start a business, and oh yeah, we could do this, or what? How did it happen?
It happened because, like this, it was sort of a beer argument. I was talking to a person at a bar one day who had invested in a similar software company that was trying to get people to use their software and then put their money to work trading algorithms. And someone showed it to me, and that I told them, I gave them they didn't know, by the way, my background. And I told them, oh, this is inherently flawed, both systemically, both market-wise. There's a million risks here.
You called their baby ugly. Is that what you're saying?
Yes, I did. And it was very upsetting because they happened to be an investor in the company, which I didn't know they were an investor. And it was this other company that eventually did go out of business. However, the person that that I talked to knew someone else, and he came to me and asked the same questions. I told him the same answers, and he felt he could build a business that if we could develop the code for him, that he could be able to market it. Well, I went down the venture somewhat with this person, but I realized this person may have some issues in terms of his ability to really get the word out about the product. To his credit, he introduced me to Randy. And Randy at the time was at Infusionsoft, and he had a software experience of dealing with all the various issues of software, customer support, marketing and sales, the things that if you build a company, you need these kind of things as well, where the other guy didn't. Well, to make a long story short, it was a choice between the guy that introduced me to Randy, and Randy is far and above the greater talent. And before I built it, I asked Randy if he was interested in this. He said he was. And then we formed an agreement and partnership, and we said, okay, let's build it out. And we got some small investor capital and built the software from there. And we are where we are now.
And you've got a pretty good track record. I mean, both Scott and I have had money in iFlip for, is that our third year, Scott? That's correct?
Yeah, I believe so. Since 2020, mid of 2020.
Yeah, so coming up on 3 years now. And, you know, people can look back, and 2020 with the COVID and everything was a brutal year for a lot of people. However, the money that
fantastic.
It
turned out fantastic for
it was
us.
fantastic. Because for the listeners, whether you've listened to the Randy episode or not, iFlip is to investing what Netflix was to Blockbuster. I mean, Blockbuster is gone. There isn't anymore. And what iFlip has the ability to do is a total, complete disruption of the whole industry. Where, Kelly, you're like, we said at the beginning, one of your dreams is to empower all individuals to grow their wealth. And it truly can be for the little guy. They can start for the little. You've been at the two ends of the spectrum, really. I mean, you've managed billions of dollars for one of the biggest banks in the world. Yet here you are developing an algorithmic intelligence that truly is phenomenal in trading in the market. So it's been kind of cool to watch just for the few years that we've been involved with it.
Thank you very much for saying this, Jason. Now, look, I feel conceptually that Main Street and Wall Street are very, very disconnected. Wall Street's job is is basically finance or merger and acquisition. It's a global center for those two things. At the end of the day, I can tell you that the wealth of this country and the world do not invest in the stock market the way most of Main Street America or Main Street world invests in the stock market. Wealthy people invest heavily into private equity, and they also invest heavily into debt instruments. And a smaller portion of their money goes to the stock market. And when the money that they do put into the stock market, because they're very wealthy, is of course still very large, but they are not concerned about getting the market return. They're concerned about getting something that the market return looks like, which is about 9.5% on the S&P 500 historically after dividend. However, they are not willing, a wealthy investor is not willing to lose 50% of their money at any time. They're just not going to buy and hold. And it makes perfect sense. If you have $100 million, you can live, obviously everybody knows you're going to live well. But to a guy that has $100 million, he has an expectation of always living well and growing that money. And he is not willing to risk $50 million to do it. So therefore, he does things completely different. When you work on Wall Street or as a fund manager, you're not handling Main Street's money. You're handling the money of wealthy individuals or institutions or pension funds. Or, for example, at Deutsche Bank, it was my risk management expertise was for what they call the house deck, which is the house deck is all the employees of the bank. In other words, it was their money. It was their prop desk. And that means their proprietary traders traded the money of the employees and of some wealthy individuals that were, owners or, big customers of the bank. Those people don't want money to be at risk like that, like a pension fund. They have to do it differently. And so if you Wall Street, though, isn't ever given these choices. They are given choices by managers to say, hey, put your money into the market and we're going to just follow you. And they hold your hand when the market goes down. They hold your hand when you get scared. And when it goes up, everybody expects it. Even if they don't make as much money as the market should make, as they should make when the market goes up. They tend to make less when it goes up and lose more when it goes down. Why do you think that is? And what I've learned, especially over the last number of years working with Flip, is, and I've said this many times before, is Wall Street and people like myself even was really throwing off that risk to Main Street, because Main Street is willing to accept more risk because they've been trained to take it. The market goes up and down. You just have to weather it out. You have to just keep investing for the long run. And that sounds so, at some levels, intuitive. It sounds provocative, but it is also, frankly and sadly, ignorant. And that is what Wall Street is. That is how Wall Street manages Main Street's money, is essentially a risk mechanism, in my mind, a risk mechanism for the wealthy and the institutional investor to be able to have a way to lay it off. They represent the layoff. That's what Flip wants to overcome. Say, no, we're not going to be part of that layoff. We'll strategically maneuver in and out of the market when we feel best practices say to be in the market or out. Best practices are algorithmic and machine learning. It's much better to use a science, we feel, and apply it. We've seen it work for years. All major institutions use it, and they don't use it exclusively, but they do use it. And we feel that iFlip is really the first kind of ultimately broker-dealer software company that will bring this kind of technology to Main Street and give them a more even playing field in the future.
Wow. Okay, cool. So what do we expect from iFlip? Well, first, why don't you give us an idea of what you're seeing in the market? I'm sure a lot of people are eager to, and I know you give the meetings once, sometimes twice a month. What's the most advantageous part that you're seeing? What, just really quick.
Currently, I personally, this is just my opinion, and it's humble, but it is based on almost 40 years of experience, that I don't like the markets right here. I don't like them mostly because I feel, hold on, sorry. I don't like them mostly because the country itself is bifurcated. Bifurcated societies, like if you look at France, or even the things that the US faced during the 70s, or even in Great Britain, over time, these are countries that don't really support deeply enough the unity of a country and what that means to the markets in general. Generally, unified countries generally do very, very well economically, and they have a very solid economic path that manages inflation and it manages employment. Currently, we now know we have a tight employment market, yes, for now. However, that's been created because there's so much wealth coming into the market from the government. At some point, that has to dry up. And I don't feel that the economic activity right now, especially when we see credit card debt going up the moon, and their defaults are rising on a literally month-over-month basis, that this is a good time for the stock market. So right now, I feel that the stock market is not a good place. There's a good alternative, which are short-term interest rates. So of course, there's going to be a lot of money on the sidelines, and it's going to stay right there when you know you can get a 4% or better yield with no risk, assuming the country doesn't default. So I don't like the markets here. I think inflation is here to stay. It's sticky. I think we'll be dealing this for years to come. And so for now, Flip actually has a very large cash position. And our hope is that we can buy stocks cheaper in the months to come.
where's Flip going in the future? I mean, it's as far as your business, what you're envisioning. I mean, what's some of the
good
next
question.
steps?
Is it real quick? Okay, we can edit this out. I have to take a quick bio break. Is that okay?
Yes,
Go for it.
2 seconds. Okay, hold on.
Yeah, the SPY eye portfolio is like, I need to log in and see a little bit more. I think
Long.
Hmm?
We've gone long. We might be able to break this one into two.
Yeah, I think so. I also will need to call Kelly right after this, Dad. So you might have to start the next one for me or for us.
You mean Kelly?
Yes,
Uh,
Owens.
Owens. I couldn't think of her last name for the life of me.
No, it's all good.
I talked to her for a minute this morning. She basically read me that email.
It makes you laugh, doesn't it?
Yeah, it also makes me feel really, really bad for the kid.
Forgive me.
He's not a kid. You're fine.
He is. How old is he?
40 something. He should know better.
Yeah, I should know better. We get greedy. I'm on Wall Street. Even bears make money and bulls make money, but pigs get eaten. That's what they say. Okay, reset. Go ahead.
We're Flip's focus for the future and where we expect it to go is currently we are evolving our processes to make the onboarding experience to Flip a great deal more smooth by opening up the ability for people to open up various kinds of accounts, whether they're IRAs or entity accounts or in eventually even 401ks could be managed by Flip Investor in the future. The other main emphasis, what we want for Flip, is to improve in many ways the way we do our machine learning. So, for example, machine learning, I feel, is an important component into what Flip offers. Flip, in its software design, for example, uses a set of money rules that are kind of universal, but unknown to most people. From things called the Kelly ratio to other kinds of betting strategies to a Bayesian form of machine learning, where we kind of integrate these things together to be able to make decisions whether we should be in or out of the market. All things are always subject to improvement as science advances and as technology advances. So there's a lot of things that are coming in the future that I think will improve Flip's ease of entry into opening account and movement of money from one account to another, as well as I think a new design for the front end of our product, so it's actually easier for people to choose what we call smart folios, and as well, maybe if they wish, of course, make their own manual decisions. Now, we can do that now, but I think we can improve this experience. We can improve the speed of it. There's a lot of great features that Flip will have to come in the future, things that are unbeknownst to a lot of people, but I think when they are revealed, they will become very clear and evident. And is to say, oh, that's a very cool feature, and we should have had that before. And they do not exist on other platforms.
Well, I want to kind of jump in a little bit. You almost make it sound like where it is right now is not all that good. I think it's phenomenal. I mean, the ability to get an account, to transfer money into that account, and then to get into your smart folios and have it work for you. I mean, it truly is Main Street's ability to participate in the market the way the elite participate in the market, right? It's an open door. It's an invitation for Main Street to participate that way. And so I'm excited about what's coming, or I want to make sure that people understand where it is right now is pretty cool. I mean, you can get to it from your phone. I can pull up my phone. Scott could pull up his phone right now. He's much more efficient than me. He'd tell you exactly what his account's doing, what it's done over the last 3 months. That's where the millennials are going, right? They're on their phones, and that's what we're doing. This is really neat.
I agree with you. I think there's a lot of great things about our product, but I am the CTO of the company, and for me, the job will never be quite done. And so I always feel there's something more that we can do beyond what we've done. The core of the product is absolutely fine. That is the most important thing. However, for me, you're talking to a man that is very difficult to satisfy, because I have my own ideas of what I think is best as well, that can be subtle improvements. They may not be initially or easily viewed by a person that goes onto our app. But for example, I care about them. One of them, for example, is speed. There's easy ways to pick up speed. I'm a very impatient person, like I think most younger people are. I think speed is a real critical issue, and I think we could be faster. You're 100% right. We do it right now, we're fine. However, there's always things to improve. Even the best can improve. We got to the moon using technology that had from 1969. I mean, that's a great thing. But obviously, going to the moon today, which we're now in private companies are trying to do, it will be, I think, a much different and more efficient process. So if we were to look back and say, would you have rather gone to the moon in 1969, or would you rather wait till now where you think there's even an easier and a better experience for it? I'll take it now. So we've come a long way and in science and technology, and I want Flip to stay on the leading edge of that.
I like that. So we need to kind of wrap up. We really have appreciated you being with us, Kelly. It's always it's a pleasure to speak with someone that's as intelligent and straightforward. And I don't know what it is. There's not emotion in some of the things that you do. It's just what you see and what you hear is what you get. I mean, it's a real genuine individual. So thank you very, very much for spending this time with us. Any parting words, Scott or Kelly?
Look, you guys, thank you very much for this interview today. I think my only parting words could be is that at the end of the day, I think investors are better off looking at science as an approach to their money and their investments, as opposed to people with good ideas. Good ideas come and go all the time, but science marches on, and it marches on in such a way that it is very linear and even polynomial at this point in our lives. So science is the better bet. It's more reasonable. And I would like investors and all people, whether you're at Flip or anybody in anywhere else, always think that, hey, what is the best way to be able to do anything? And it should be in the form of a very logical, scientific methodology of seeing what is best and what is not. And that's what we do at Flip Investor.
And again, for all of you listening, like Jason and I have personal experience, a couple of years now working with iFlip, and we highly recommend not only Kelly, but the technology itself. It's just absolutely outstanding. So one of these days we'll get you in the real estate market, Kelly. Anyways, guys, thanks for joining with us. If you would like to find out more about iFlip or connect with the team over there, we will put their contacts and links in the show notes down below. If you'd like to connect with Jason or I, make sure to hit us up on Facebook, Instagram, or Twitter, or shoot us an email. Again, you will always find those links in the show notes below. And last, remember, mastering your millions all starts with your mind and your team. Make sure they are the best. Catch you next time.
Thanks for listening to Master Your Millions with Jason and Scott Henderson. Check the show notes for any links or contact information about today's guest. Make sure to follow the show so you don't miss any future episodes.